Okay, good afternoon, everybody. Welcome to our webinar this afternoon. First of all, wish you all a happy St. Patrick's Day tomorrow, or St. Paddy's Day. And it's definitely not St. Patty's Day, as some of our American friends call it. And as you can see, Grant Thornton will be turning green tomorrow, as will a lot of the rest of the world. So enjoy your day and enjoy the day off. And today we have a webinar in relation to commercial property and opportunities that are available for people to purchase property in this vein. And we have three speakers for you this afternoon. Our first speaker is Angus Burns, who's a partner in Grant Thornton, and Angus will talk about acquiring investment property through pension structures. We have Mark Hawthorne, who is one of the lending directors in Capital Flow, and Mark will talk to us about lending guidelines in Ireland for purchasing commercial property. And finally, then we'll have Conor Whelan, who is managing partner in QRE Real Estate Advisors, and Conor will give us a view and an idea of where the commercial property market is in Ireland at the moment, which I think is very topical, and I think there's a lot of misinformation out there about it. So hopefully Conor will be able to address those issues. So if you have questions or whatever, you'll see the Q&A button below presentation. Please put your questions in there and we will have a Q&A session at the end. Ideally, if you could put in your contact details on the Q&A rather than putting in your questions anonymously, as if we don't get to answer them during the presentation, we will come back to you directly afterwards. So without further ado, I'd like to pass over to Angus. So Angus.
Thanks very much, Colin, and happy St. Patrick's Day tomorrow to everybody. I'm wearing a green tie, by the way. You can't quite see it behind my name, but I'm definitely not intentionally the only green tie I could find there this morning. So I'm delighted to have found it. So I'm going to talk about using the pension structure to purchase commercial property. First of all, a little bit on GT. We've 7 offices across the country, 1,500 employees, just over 50 partners in the firm. We're an accountancy firm, and we've a broad range of services across advisory, which is my area, tax and audit. So in terms of purchasing investment property, and look, I'm not going to go into ICAVs and QUAFs and all the kind of private equity structures that Conor loves, and he might nod to later on. But I'm going to talk about ordinary Joes here, the middle class investor, and how to build up wealth tax efficiently through purchasing investment property. And I like to put the structures into three kind of pots. But we're most au fait with purchasing property personally. Okay, I suppose the problem with purchasing personally is that most investors derive their initial equity, let's say, from salary or from a business that they have. Okay, and of course this initial taxation on that equity piece. So in this country, you're generally starting out with half the amount of money because you've just written a check to revenue before you get on the journey of investing. And then once you've purchased your property, you're taxed again at over half at the higher rate on the income, which is the rents. And we have 33% rate of capital gains tax on the gains. It used to be that there was a suite of capital allowances that promoted and encouraged property investment in the country for various reasons, including political. They were phased out. So we're in a situation where it's quite difficult now to invest in property personally. And really the big reason is down to taxation. More popular of late has been use of corporate structures to purchase investment property, in particular where the funds are derived from a company itself. So you're not withdrawing the required equity from the company and being taxed at that point. Within the corporate as well, you have a reduced corporation tax rate and closed company surcharge that are less than the higher rates of income tax. You do still have capital gains tax exposure. And of course, at the point when you're required to distribute funds from the company, you have further taxes at that stage. But as a way of using funds in a company to purchase property, potentially some more efficient tax angles than at the personal level. What I want to talk about today, though, is the use of the pension structure. All employees in Ireland are in a position to use a pension. There's a €2 million standard fund threshold available to everybody. Effectively, it's a tax incentive or tax relief available to people to fund their pension. And that pension can be used, that pension structure can be used to purchase commercial property. The key first part of it is the tax relief on contributions into a pension structure. Okay, so that's the initial hurdle where there is no benefit in kind and no taxation on contributions into the pension. So no tax on the initial equity. And once those funds are in the pension structure, there is no tax on income and no tax on gains, capital gains, as long as the funds and the assets are in the pension structure. Okay. There's a 2 million standard fund threshold. So the idea here is to fund your pension up towards the 2 million level. And at a point of retirement, or once the 2 million standard fund threshold is breached and you're over 50, which is the early retirement age, or you could be below the threshold, you have the opportunity then to transfer the pension assets into a post-retirement vehicle, like an approved retirement fund. There's no limit on the size of the approved retirement fund. You cannot fund it from your employment any further, but there's no limit on its size, and it continues to grow tax-free. Of course, you can withdraw funds from the post-retirement vehicle, the approved retirement fund or a vested PRSA, by way of a tax on distributions after a tax-free lump sum is taken. So again, quite a tax-efficient structure, and we'll look at how that is that's used further. There are a number of options, pension structures that can be used as a self-administered option. I suppose the most popular that we see is the route, the employed route, where one is an employee and pension contributions are made by the company, by the employer, generally into the pension structure. Okay, and the reason why that works well is that it's possible to make contributions of a multiple time salary. It's possible to back fund salary pension contributions, and the funding can be quite significant using the employer route. There is a possibility to, as a self-employed sole trader, as in not an employee, to fund into a personal pension, for example, use of the self-administered PRSA. I suppose one of the major difficulties with the PRSA is that personal contributions are somewhat restricted to a percentage of age capped at an overall salary, an overall income level of €115,000. So really you're talking maximum €30,000 a year contribution into a PRSA. That's very different to the employed route, where a multiple time salary can be funded into your pension. However, the self-administered PRSA does have other benefits once your pension is funded, and we do see clients using the self-administered PRSA. There are things such as the BOBs, the personal retirement bonds, which are single premium pension vehicles. It can be used for transfers from past employment and do have a self-administered option. And then I spoke before about the self-administered ARF, the post-retirement vehicle, has the self-administered option as well. And investment options are the same for all. We're talking specifically about direct property, but deposits, direct share dealing, regulated and unregulated funds. In terms of the different types of pension, I suppose the standard pension offering, possibly with a life company, the funds will be limited to for property investment to property funds, exchange traded funds, and REITs. However, the self-administered pension opportunities is much more open architecture, including direct property direct property investing, including office, retail, industrial, which Conor will talk to. It allows for co-ownership, syndicated investment properties, loan notes into property structures, and debt is available in the market, and Mark will talk to that. I wanted to move to a case study that is tweaked somewhat towards purchase of commercial property. But let's take an example where there are funds built up in a company, an employer, in this instance, €250,000. Now that may be over 5-10 years. It may be an accumulation of funds, but in order to take those monies out of the company, we have a significant tax hit. In this instance, I've applied the higher rate of 55% for monies over €100,000, but it could be 52% tax on salary, also by way of PAYE, USC, and PRSI. So you can see that 250,000 accumulated and due to the individual from a company dwindles quite significantly down, in this case to 112,500 after the tax man has taken their cut. Off you go and buy a small retail unit in a town. In this instance, I've applied an 8% net yield after management charges, if there's a management company, or the agency fees. But again, the taxman has another swipe at it. In this instance, I've applied a 52% tax hit, and we can see that the return of €4,000 or so on the initial 250,000 is quite poor. Let's apply the same scenario to the pension. €250,000 may be accumulated through other pension structures, accumulated as bonuses and payments to the individual over the years. But in this instance, amounts due to the individual were paid by the employer into a pension structure. Okay, there's no leakage of tax here, so the full 250,000 is intact. Okay, go off and purchase 2 and a bit units in this comparative case with your 8% net yield, for example. Here, there's a requirement for a pension trustee, which Grant Thornton provides that service. But you can see that you're ending up with over 4 times the result here. Why is it 4 times? Well, in the other example, you started off with half the money and you had half the result because you're taxed twice. In the pension, there is no tax at the first stage and there is no tax at the second stage, hence the 4 times result. And that's purely on the yield. I'm not taking into account any capital appreciation there, which would be magnified. Of course, there are some restrictions around this tax-exempt structure. The first one is the arm's length requirement. So revenue are particularly allergic to connected party transactions. So we do not want to see you dealing with family members business associates, business partners, etc. They want to see arm's length transactions here. Ditto for the tenants. These are the pension is for investment assets only. It's not for trading assets. Revenue doesn't want to see you operating your trade through your pension. It's investments only. So while you can build out property in a pension and hold it, what you can't do is develop a housing estate, for example, and flip the properties as if you were a property developer and trade. And of course, the idea here is to have sufficient assets and ability to sell assets in the future to provide retirement benefits. Let's look at a case study here involving debt. So on the personal side, you might recall after a 55% tax hit, we had 250,000. Now we have 112,500 in equity. We go to Mark. He offers us some debt. Okay, and now we gear up. So we've geared up there with 60% loan to value, and we're up to 280,000 euro, and we have a net rent at 8% yield coming in. Okay, there's no trustee fee because you're doing this personally. Okay, unfortunately, you have a tax hit. While you do get some shelter from the interest that Mark is charging you on the tax, you still have a tax hit. So you have less money available to service the capital and interest bank payments. And in this instance, you have a deficit. Now, I don't think this first scenario actually stacks up from a banking perspective. And the reason it doesn't stack up is because there's insufficient headroom there to service the debt. Why is there insufficient headroom? Well, because of taxation. Let's look at the pension. We're intact with our 250,000 euro available for investing. There's no leakage of tax on those initial monies. We leveraged up in this instance to just over 600,000. We took our 8% net yield of 50,000. Yes, we had our trustee fee, but no, we didn't have any taxation on the income. We have a significant rental income. I'm saying here net of tax. There is no tax on it. And in this instance, there is more than sufficient monies available to service the capital and interest on a 15-year term at that interest rate in this scenario. This is not Mark's case study, by the way. This is my case study, but hopefully it's reflective of the kind of deals that we're seeing at the moment. So very much pension and debt, because of the lack of tax, more overhead to service debt repayments. We'd be saying a more robust structure to invest with debt. Revenue, of course, have some rules around borrowing. They're focused more on the lender rather than the borrower. Okay, so they don't allow cross-collateralization, recourse to other assets, assignment of rental income. Revenue don't permit interest-only loans. They have a maximum term that revenue require 15 years, no more. While you can refinance the debt, revenue don't want to see you doing equity releases with pension debt, and there's no direct borrowing in the ARF, in the post-retirement vehicle later on. So it's more of a pre-retirement play. So what kind of property opportunities do we see? We see multi-tenanted properties, mixed-use properties. In terms of commercial properties, you know, the lenders often like to see strong covenants, whether it's council tenants, semi-state properties. We've even seen the likes of primary care centres banked using pension structures. We see individual investors, we see co-ownerships, syndicated investments, and we see use of property funds as well. So in terms of a few takeaway points from this piece of the presentation, we believe the company structure in terms of employer contributions works well to fund a pension. The self-administered structure is more flexible than insured pensions, which are limited to a number of of property funds, but don't permit direct property investing. Property usually generates an income, and that income can be designed to be very useful in retirement, to fund retirement, and generally a steady kind of income. There are opportunities out there in the area of social housing, but also with commercial state tenants, where there can be very strong covenants available to support debt. So when purchasing investment property and commercial property, I would say explore your pension options first. If that doesn't work for you, there are other structures, but certainly the pension can work very, very well. So I'm going to hand over at this stage to Mark Hawthorne from Capital Flow, and Mark, over to you.
Thanks, Angus. Firstly, just want to thank Grant Thornton for organising and hosting today's event. I hope everyone finds it useful. I'm conscious that not everyone may know who Capital Flow are, so I just want to spend a little bit of time giving people a background in terms of a feel for who Capital Flow are and what we do as a business. So Capital Flow, I'm having trouble here, guys, moving the slides on.
Stick it with there once, Mark, and then move it.
Yeah, okay. Yeah, so I'll just maybe kick on. Capital Flow basically have three main products: property, asset finance, and invoice discounting. So in terms of our property lending, we can do pension mortgages, property bridging, and property term loans. In terms of asset finance, we do hire purchase, leasing, and refinancing of unencumbered assets. So enables companies to release working capital against assets they currently own. And invoice discounting is the third product. So effectively, we're an asset-based lender. In terms of sorry guys, we're a bit slow here and moving things on. Valerie, do you want to maybe take control, and I'll just ask you to move it on just so that I can keep it moving along?
Yeah, I'll move them for you there.
Yeah, cheers, thanks. Yeah, so a little bit of background about us in terms of Capital Flow was set up in 2016, and I suppose what's the key aspects or the key things that have allowed us to grow to be one of Ireland's largest non-bank lenders. So with 50 professionals, 50 people, over 50 people employed in the company at the minute across a number of different offices in Dublin. So I suppose a couple of the key elements for Capital Flow is that we have an experienced team, and one of the things that we've tried to focus on since inception of the business is building partnerships, not only with borrowers, but with introducers. We want to get to know the people behind the transactions, and you know what makes them tick, essentially. And in doing that, that's allowed us to grow long-term relationships with all key stakeholders, and allows us to generate repeat business. In terms of local, what I mean is, you know, we have local decision makers who understand the market, and that's in terms of credit decision makers and lenders on the ground in terms of our coverage across the country, and that allows us to make timely and effective credit decision responses to borrowers, which is very, very important. Our parent company, Pollen Street Capital, is a London-based investment management company that specialises in financial services and business services companies. I suppose their largest portfolio company would be Shawbrook Bank in England, that has a balance sheet of 5 billion. In terms of Ireland, aside from their investment in Capital Flow, they're also involved in BidX, the online property transaction portal, and Ariza, which is a business services platform software company. So in terms of what we've done so far, 550 million across the products that I've already outlined to over 3,000 customers. You can move it on to the next one there, Valerie, please. So I suppose the synopsis in terms of what we're trying to get across here in this slide is the key deliverable, I suppose, for any funder is delivering a response and understanding what borrowers want. So what we try to do, as I've said, is get to know what borrowers want in terms of a funding structure or maybe a flexible funding solution. And what I mean by that is potentially higher loan to values, get to know their credit history that may have been a hangover from the previous recession, and get to know the people behind the deal. Ultimately, what we want to do is we want to try and do business and get deals over the line. And that's all about the relationship focus that we have. You move it on, Valerie, please. Yeah, so before I specifically get into the pension mortgage, the key features, I suppose I just want to highlight a couple of things in terms of why capital flow as a business like pension mortgages, and the feedback that we get from pension holders in terms of why they like the product. So from our perspective, the risk profile in deals tends to be lower than other transactions, and the reason for that being is that there's lower loan to values, which result in higher repayment capacity from the properties, and you're dealing with investors that are liquid and have cash that are going into the deal. So from our own perspective, that gives us a strong credit appetite to want to lend into this specific product sector. And then in terms of the pension holders themselves, aside from the tax benefits that Angus has already outlined, there's two or three main things that the feedback that we have been given in terms of why people want to buy property through their pension. The first is in terms of, you can see it on the presentation there, we lend to unit trusts. So effectively, we take a first fixed charge on the property, so it's non-recourse lending. The second point, and probably the key point that we get, is that the pension holders get to take control of how their funds are invested. So property is an asset class in Ireland that people are very, very familiar with. They're very comfortable with it, and they can use their experience in terms of that experience and profile with properties in terms of taking that control and where their money goes. And that's a key feature for how we see people driving the acquisition of properties through their pension. And the last point that kind of takes a combination of all the different aspects is there's greater purchasing power. So if you think of the tax relief of the money going in, the tax benefits in terms of the income, it means that the capital or the acquisition power that the funds have in the pension is much greater. It allows for pension holders to contribute more in terms of the equity into transactions. It therefore allows for higher debt service cover, and it just provides a higher quality in terms of the deal and lower risk profile, not only which is a good thing for us as a lender, but also for the pension holder who wants to have an income producing asset in retirement. So in terms of the residual couple of pieces on this slide, I've already covered the first two. Minimum loan size is 125,000. Maximum loan to value is 60%. So effectively, you're looking at a property value or purchase of 210,000. We provide term loans of 7 years, but repayment profile can be over 15 years. So effectively, what that means at the end of the 7 years, the pension holder will have to have the option of refinancing it again with capital flow or repaying the loan if they're in a position to do that. And as Angus has already said, repayment profile is always on a principal and interest basis. Thanks, Valerie. In terms of loan criteria or the areas that are critical to us in terms of assessing deals, particularly commercial, there's three specific things. So what category or what properties do we lend to, location of those properties, and then how do we assess the income? So in terms of the assets that we lend to residential, commercial, or a mixture of both. In terms of our own portfolio, we've seen the mixed asset portfolio in terms of the ground floor, commercial and overhead apartment, residential, being a very, very popular way for people to invest through property in their pension. In terms of location, it's town cities with a population greater than 10,000, and that's a fairly standard criteria for alternative funders. In terms of this slide, and probably one of the key things to take away from today is how we assess commercial properties, and particularly the repayment capacity. So for us, it's about understanding the sustainability of the rental income. So in other words, the leases or the lease in place at the point of the property being purchased. So I suppose the easiest way to explain it is how we assess the credit risk is how is the loan going to be repaid. So 90% of the time, in terms of the products or the applications that we get, there's long-term contracted leases in place, and that therefore easily allows us to assess how the loan can be repaid over the 7-year term. Now, that's not always strictly the case. For example, I'm working on a proposal at the minute that's mixture of residential commercial in Dublin 6. So ground floors actually vacant with income being produced from the apartment overhead. So how do we assess a proposal or a deal like that differently from one that has a full income stream being generated? So we'll look at the loan to value, we'll look at the property location, and we'll look at the property condition, and ultimately we'll look at the pension holder, because ultimately, one, their experience in terms of managing that process of getting the vacancy sorted out and the suitable tenant in place is key. And secondly, what liquidity do they have in place in terms of the pension in order to continue meeting the repayments for that void period. So those are the key kind of aspects that we have, and obviously there that kind of brief point on the left hand side, we can complete multi-asset single loans, and what we mean by that is if someone wants to buy, for example, 6 apartments, we don't split it up in terms of one facility for each of the 6 apartments. It's one loan for one acquisition, and that's just something just to bear in mind as well. In terms of the application process, I suppose what I want to get across here is just, I suppose, how, not that it's how straightforward it is, but how efficient it should be in terms of going from start to finish. In terms of when we establish interest in terms of a potential acquisition or potential proposal, for us to be able to qualify the lead, it's very, very straightforward. We need some very basic pieces of information, which include the property. So what's the location, the property cost or value, and then secondly, as I covered off in the previous slide, what's the rental income, so your tenant, what are they paying, and what's the terms of the remaining lease. So on the basis of getting that very basic information, we'll be able to assess effectively there and then whether the proposal meets our credit or lending criteria, and it will allow us to issue the term sheet and the pension application form for completion. So once we get all the information that needs to be gathered, the term sheet back signed, pension application form completed with relevant information, and in some instances we'll need the red book value specifically for commercial property prior to credit. Once we have all those points of information, we would expect to have gone through credit and had a decision within 5 to 7 days, at which point then we can issue the offer letter and engage solicitors to complete the legal due diligence. Thanks, Valerie. Yeah, so I've included here a couple of pension deal samples. All 3 are commercial properties. So as I've said, I suppose the common theme in terms of what we see is pension holders looking to acquire properties that have good income streams. And you know, as I said, that's not only a good thing from a lender's perspective, but it's also important from the pension holder's perspective, in that, you know, there's not an unnecessary risk being taken in terms of the investment that they're making. They want a property that has sustainable income, that's going to provide them with income in retirement. So a quick run through of some of these examples. The first property is mixed use ground floor retail in Dublin with overhead apartments, 56% loan to value. Again, the residential aspect in that, you know, gives a portfolio mix in terms of income, which is always positive. The second deal is an office block that was purchased in Portlaoise, 50% loan to value, multiple commercial tenants with a different range of leases in place. But again, the range of commercial tenants and different leases mitigates the risk in terms of anyone with short or medium or long-term leases. The last one is an industrial unit in Galway, 58% loan to value. So just give you a flavour in terms of our appetite, in terms of there's no specific requirement for property. You know, for us, it's more about you know, where's the property located, and what's the income of it. I mean, the specific property or asset class isn't as important. There's a couple of the next two slides are more so for people just to kind of go through in their own time in terms of to give you a flavour of what we're doing at the minute that's non-pension, bridging loans, term loans in terms of Dublin apartment or a portfolio investment in a large city in the northwest. So Valerie, you can skip on past, yeah. So just, I suppose, to summarise capital flow in terms of, what we're seeing over the last 12 months, in spite of the challenges in the market, the pension mortgage product has held up very well. As I said, credit proposals tend to be very strong, low risk, good income streams, strong promoters, a lot of people that have experience with property. So yeah, look, capital flow have credit appetite to do business, but it's a product that we see a lot of people availing of, especially when you consider the continued transactions in terms of the banks selling portfolio sales and the funds picking these type of assets up and bringing them to market. So when you take into account all the different aspects that Angus has brought you through in terms of the tax benefits and the numbers in terms of why people should do it and the ability to get funding for it, it's a really positive product that we hope to help grow through the next 12 months. Thanks, guys.
Very good. Thanks, Mark. It's Conor Whelan here. Valerie, will I just go ahead?
Yeah, you should have control there, Conor.
Thank you. Good morning, everyone, and or good afternoon, everyone. And thanks to Grant Thornton for the opportunity to speak today. And good to be working with Capital Flow again, who are well known to us, as well as Grant Thornton. I suppose, first of all, to give everyone a bit of background on QRE, we were established like Capital Flow in 2016, and we are a full-service real estate advisory firm. And what that means is we provide advice across all aspects of the commercial property lifecycle. So we've got 4 business lines: letting, sales, advisory, and asset management. Today, I'm going to talk to you a little bit about the property investment market. I'm sure you all read the papers and you all read the various reports that are issued on a quarterly and annual basis from the various different firms. I think what I'm going to try and demonstrate today is that there are 2 aspects to the investment market. One is the institutional market and one is the sub 20 million euro market. The sub 20 million euro market is where we believe the private investor like yourselves, the family business and the smaller fund would invest in Ireland. But certainly we're going to talk a little bit more in more detail today about the sub 20 million euro market and the realities of what's going on in that sector. Doesn't seem to be working, Valerie.
Just click the screen there, Conor.
There you go. Okay. Now, what I'm going to talk to you all about first is the occupier market. I think it's important we have a chat about the occupier market. That's effectively the leasing market. And, I think it's important that we understand how each sector in the commercial property market is performing on a leasing front. We all read the papers, and again, what I'm going to try to do is allay the perceptions out there. When you read the papers, you'll see at the moment the industrial market is performing very, very well. That is factual. That is the best performing sector, probably in the context of take-up. Certainly, last year it's done very well. Hasn't been impacted much by COVID. Take-up figures last year were 3 million square feet, and to put that in context, 2019 very similar take-up figures. So the industrial market has not been affected. The reason for that is e-commerce. We're seeing more and more companies now looking for bases to deliver from in Ireland, and Brexit is also having an impact on the market. What we've seen last year is rents harden in the industrial market. They've remained at 10.50 a square foot. Lots of new inquiries in the market. The problem is that there's not enough space being developed at the moment. The vacancy rate is very, very low, 1.8%. And we anticipate going into 2020 onwards that actually there'll be a lack of product in the industrial market this year to satisfy the demand. So I think that's the good. But when you read the papers about the office market, you know, what you read is the, you know, about the death of the office market and what's going on there. But really, when we look at what happened in the office market last year, 1.7 million square feet of take-up, which was down approximately 45% on the year before that. And that sounds a reasonable return, I suppose, in a market that really people couldn't occupy offices. But when you dig into numbers a bit more, 1 million square feet of that take-up took place in Q1, and only 700,000 square feet of take-up took place in the last 9 months of the year. So COVID certainly has had an impact on the office market, and I do think it has impacted rents somewhat. In saying that, transactions did happen last year, some very, very large transactions, and they continue to happen this year. And, you know, rents have been affected slightly, certainly in the corporate sector, but I would say the adjustment is probably in the order of 5% at this time, and perhaps occupiers are getting a little bit more rent-free. But certainly we're very active in the office sector. We have completed deals, and we're about to complete a couple of deals this year. And what I can tell you on the larger scale occupier front is in both the suburban market and the city centre market for large scale lettings, rents haven't been impacted hugely. I think when you look at the smaller secondary space, you know, we've yet to see what's going to happen there, because frankly the transactions just aren't happening at this point in time. But I suspect the Georgian office market could be slightly hit, maybe some grey space coming on, so sublet space that come on. That sector of the market could be impacted, but it will be interesting to see, you know, how that happens this year. I think the first half of this year, when the stats come out in Q1 and Q2, you know, they're not going to read well, because effectively people are holding, our companies are holding off now until such time as they can occupy the space. But I believe by, you know, from June onwards, when the vaccine takes hold and, you know, people can get back to the office, I suspect that, or we suspect that the market will improve and take-up figures will improve accordingly. So on the retail market, I suppose I define that as ugly, but it's not yet that ugly, but it has potential to become ugly. I suppose what we're seeing there is, you know, a lot of press coverage about, you know, retail and the impact online is having on retail. And yes, it certainly is. And I think when you look at, you know, what's happening on a nationwide basis, and certainly if you look in the UK as well, what's interesting is the high street and shopping centre retail definitely has been affected. You know, there was reports in the paper last week of rents on Grafton Street falling by as much as 20 to 30%. And I'd say that is the case. And frankly, I believe an adjustment was required on the high street, both here and in the UK. And we're probably going to see that now. But when you look at the suburban market and, you know, local retail, and we're involved in a number of lettings over the last 12 to 15 months in the suburban market, it's holding up pretty well. And I mean in the context of rental value and demand. Necessity retail is in demand, and we are seeing, you know, local villages or areas such as, you know, Rathgar, Ranelagh, Dalkey, Clontarf, Malahide, these kind of places. Vacancy rates are still very low in these places, and when retail does come online, you know, it tends to be taken up relatively quickly. I think that's interesting, because if you were to believe what you read in the papers about, you know, where retail is going, as an investor, a private investor at the moment, you might say to yourself, I'm not going to get into that sector. But what I'm going to try to demonstrate to you later is that, you know, in some instances, retail can be a good buy. What I want to demonstrate to you here is, I suppose, again, the perceptions and realities around the investment market. And what I want to do is, I'm going to refer you to the year is the first column, total sales in that year is the second column, and then the value. If you look at the value column there, which is the third column over, 2016, the value of the market was 4.5 billion in investments in the investment market in Ireland. And then it went to 2.6 billion in 17, 3.65, 7.2 was a big year, included the sale of Green Wheat, and then 3.1 billion last year in the investment market. So on the face of it, last year looked like a reasonable year in the Irish investment market. As I said to you at the start, what we tend to do in QRE is we have a look and we delve into the numbers a little bit more, and we look at the sub 20 million euro market, which I believe is what our participants today should be most interested in, because that's probably what you're going to invest in. And if you look again at the value of that market, which is the last column over the last 5 years, you can see it was almost €1 billion in 2016 and 2017, but it fell in 2020 to just €400 million transacted in the entire sector. And that was a total of 81 transactions. So what's that telling us? It's telling us that, I suppose, a number of things. If I look at the numbers, in 2018, what we, QRE, were vocal about in the papers was the market, rents had steadily rose, yields had steadily compressed, and values then had plateaued. And the buyers, the investors out there who we were talking to every day of the week, were saying to us, look, they felt the market had got a bit hot. And that transpired then into 2019 because there was an adjustment required. The vendors, the people who were selling the assets, you know, we had a terminology in here called price cancelling, where we were going to vendors and saying, look, the market perceives assets as being too hot. We think you're going to have to offer an enhanced yield and thereby reduce the value. And it took a while for these vendors to take the advice, to heed the advice, and to get their properties onto the market. What happened then was the market dropped from 223 transactions in 2018 down to 160 in 2019, only 700 million traded. And then last year, the opposite happened, where the purchasers felt that they could rob assets in what they felt was a distressed market. The vendors tended not to be distressed. They weren't under pressure to sell. And what they decided to do, rather than sell into a distressed market, was they decided to remove their assets from the market and wait till this year. And that's why the value of that market fell so much. There still are plenty of assets, ready for sale. We're involved in a significant number at present. And again, because of where we are with COVID, and because of how difficult it is to view assets at present, what we're advising clients is to hold off. And I think what you're going to see in Q1, certainly this year, is probably bad numbers again in the investment market. But I think that's predominantly as a result of COVID, and we do anticipate that things will improve, as I said, like the office market, once offices open back up and the market normalizes somewhat. I think if I push it on one more, again, when you look at the institutional reports that are out there, what they will say to you, and when you read them, is that PRS and which is the residential sector, and office is the sectors that are attracting the most capital. And that is true in the institutional market. But again, when you look at the sub €20 million market and analyse where the money is going in that sector, what you'll see over the last 3 years that it was actually retail is where the money was invested. And in a lot of cases, depending on the guys touched on it earlier on, location and content, etc., and I'll talk to you about that in a second, retail can still be a good investment. I think Mark referenced mixed-use investments as well as an example. And you can see last year 21.7% of the total market, and if you had 16% in 2019 and 22% in 2018. That's where the sub €20 million investors, that's where they were investing their capital. So I think what this slide tells us here is that actually offices, retail, and mixed use is where the private investor at the moment is investing their cash. And you can see then as well that the industrial market, which was, I suppose, classed as a very unattractive sector in 2018 and before that, is slowly but surely becoming more and more attractive for the reasons I discussed there. People always ask me and the company, where should we invest? And I suppose that the reality to that question is most sectors, or any sector, can be a good place to invest. You can invest in a Georgian office building here on Fitzwilliam Square, and if the fundamentals are wrong, it's a bad investment. If the fundamentals of that investment are right, it's a good investment. And that goes for industrial and retail as well. I think what I would ask people to do when they are considering it, you must take advice on it. You must take advice from a firm like ours or another one, who's going to do a due diligence, give you a view on the asset in the context of a number of aspects. I think, you know, when we started the business in 2016, we were dealing with a lot of assets that had bad title, and a lot of that has been resolved now. The title is obviously fundamental to the strength of an asset. You got to look at your zoning. What can you do? What's the user permitted on it? If I wanted to develop it in the future, what can I do? The actual condition when you're taking on is obviously important. The covenant strength of the occupier, that's critically important. Do they have the ability to pay the rent? The user, what is the end user there? Do I have flexibility if that covenant or if that existing user vacates the property? Obviously, the rent is very, very important, but I think more important than that is the rent review clause. And when you're looking at the rent and the rent review clause, when you're buying an investment, you must try to understand, is there potential rental growth in that asset? The rent review clause is the most important clause in the lease, and people don't realise that. I think we have a very strong rent review team in here in QRE, and they've just produced a document. It's called The Ups and Downs of the Rent Review Process. Katrina Ryan, Hugh Markey, and Paul McInerney. Their document on the rent review process is available online on our website. And if any of you guys have rent reviews coming up, I would suggest you go and open that just so you understand how important the interpretation of that clause is. Obviously, lease term is very, very important. Whether or not there's break options in the lease is very, very important. If there are break options in the lease, what are the repairing obligations and the reinstatement provisions provided in the lease? So if the tenant does leave, do you get the property back reinstated or not? The local market is obviously very, very important. I mean, you know, I've talked to a number of investors, some of who are on the phone today, but they may live in Clontarf or Malahide or Dalkey, and they know their local market from being down there, and they know that certain units in that locality have never been vacant, or if they became vacant, you know, they were re-let fairly quickly. So, you know, a knowledge of the local market is very, very important. The history of demand in that location, you know, the re-letting potential, all the same kind of things there. As well, when you're buying an asset, is there an asset management potential? You know, can you, you know, develop another floor on that asset? You know, can you perhaps enhance the rent? Can you remove a break option out of the lease in return for maybe a lower rent to enhance value? So these are all the things that, you know, you must look for when you are buying an asset. And as I said to you, it's very difficult for me to say to everybody today, look, you should only invest in industrial, because the reality of it is, when you drill into this sector of the market, that most sectors are performing. Yes, they are under a little bit of pressure at the moment. There's no doubt about that. But we do feel that each sector, bar probably high street and shopping centre retail at present, hasn't been impacted, you know, detrimentally during COVID, and it has every chance of coming back. I think that's all I want to say for the time being. Thank you.
Okay, thanks, Conor. Really appreciate that, folks. We're running reasonably well on time, so we've a couple of minutes for a few questions. Maybe, Conor, if I could just go back to you, seeing as you're the only one who hasn't gone on mute again. So quick question that came in there in relation to your view on smaller towns around the country and future of commercial and in particular mixed use properties. Do you see it as it's like the town kind of dying out?
Town.
Sorry.
Sorry, Colin, you said
towns. Yeah.
In towns, regional towns.
Regional towns. Sorry.
Yeah, and look, again, you know, again, it's about local market, Colin. It's about understanding the market. I mean, you know, at present, I suppose you're asking that question to me. I would stay probably away from regional towns at the moment, just because of the associated risk. But some towns are different than other towns, and depending on the setup of that asset, you know, if you have, you know, one of the pillar banks on a 25-year lease in a town that has a lot of future potential development going to happen around it, that's a commuter town, Dublin, you know, that's probably a safe bet. But, you know, would I buy a vacant unit, you know, on a small street in a regional town at present? No, I wouldn't. So I suppose very hard to answer that question without being, you know, asset specific.
Sure, but what you're saying is be cautious, really.
Well, be cautious, but again, you know, you know, each asset and the setup of each asset is different. So it really does depend on how the asset's set up. But I would be cautious at present, certainly in retail and regional towns, yes. Okay, thanks. Mark, a question that came in there in relation to refinancing and you releasing cash for people to purchase on. I'm assuming it can't be specifically related to pensions. I think it's a more general question, but I think it's important just to mention on the pension front that you can still refinance a pension loan, but you can only refinance it at the level that the original loan was approved for the purchase of the property. You can't top up a pension mortgage. But just on a general basis, Mark, is that something that you guys are doing a lot of?
So on a general basis, yeah, we can release equity built up in a property, whether you know it's you're refinancing a low level of debt or whether it's an unencumbered property. Yeah, we can do an equity release to allow someone to purchase another property.
Okay. And if I can just maybe one more question, Angus, for you, a question. I mean, can you backdate the pension when the company started, and if so, how long?
So I think this question is around backfunding of your pension. So effectively catching up on contributions into your pension. So what we do for each investor when we're looking at how much can be contributed from the employer into the pensions, we do a funding test, okay, and it's based on age, years to retirement, salary, existing pension benefits. You recall the 2 million standard fund threshold, which is a maximum level. And we look at what the potential is to make contributions into the pension. So in many cases, there's significant potential to catch up. And you know, obviously, the older one is, the less years to retirement, the lower the amount of pension benefits already in the pension, and the higher the salary. That the more scope there is to backfund and to catch up, and we've quite significant investments, sometimes in excess of €1 million of backfunding made into pension. So we've quite a generous system, I would say, in this country.
Okay, good stuff. We have one or two people who have raised their hands, might want to ask questions. John, would you like to ask a question there? You need to unmute yourself. Sorry, John, can you hear us okay? Yeah, that's it. If you just want to ask a question, John, we should be able to hear you.
Hiya, can you hear me now?
Yeah.
I'm just wondering about the towns with a size of under 10,000. Is that a no-go area? Is it for a mortgage?
From a lending perspective, I suppose that's Mark.
Yeah. So John, I suppose in a short answer, it tends to be yes. But I mean, do we do it? The answer is also yes. So I suppose, as Colin mentioned earlier on, it all depends on who the tenant is, and something that they're seeing regularly at the minute in terms of acquisition and tenants is government bodies in terms of social housing or primary care centre. So I'm actually doing a primary care centre for a property in a pension deal at the minute, which is a sub 10,000 town. But if you're talking about just normal commercial tenants, yeah, sub 10,000 is something that there's very little credit appetite for, but it's case by case, and you know, as I said when I was running through how quickly can we provide an assessment of a proposal, I would always say, look, run the deal past us first and let us have a look at it and be able to give you a bit of feedback in terms of whether it's for us.
Great. Okay. Thanks, Patrick. If you'd like to ask your question now, please. You just unmute yourself there. Okay.
I might just come in. There's a question there. Is the 2 million cap on pension including the loan amount if borrowing? And look, just to be very clear, that the 2 million cap is the net of debt asset value. Okay, so you could have 3 million in property, 1 million in debt, and that the 2 million cap applies to the net of debt position.
Okay.
You have a bit more to spend there.
Okay. Thanks, Angus.
I think we're probably up on time.
Yeah, we are. We're just up on time. So for whatever reason you can't ask the question, if you'd like to forward it on to myself or put it in under the Q&A, we will definitely get back to you. I'd like to thank everybody for coming along today. Very much appreciated. Enjoy your Patrick's Day tomorrow, even though it's not the normal Patrick's Day. Wear the green jersey, as they say, and I think that's really important, and it's something that we've always pushed here in Grant Thornton. It's really important we all support each other, during these times. So thank you for coming along. Thank you to our experts. Really appreciate the presentation, and we look forward to seeing you guys again soon. Thank you.
Thanks.